Want to sound like a real estate insider? Here are 7 commercial real estate terms you need to know. Let's roll the video.
So you're staring at a commercial real estate deal and you're thinking, is this the one? How do you really know if it's a winner? Well, it all starts with speaking the language. These are the 7 essential terms that really separate the amateur investors from the pros. Because a great deal always starts with clear definitions. And this is all brought to you by our friends at Real Estate Rank IQ.
All right, here's our roadmap. First, we're going to follow the money from the property's income engine all the way to its final value. Then, we'll figure out how fast your cash actually comes back to you, and, this is a big one, if the bank will even give you the loan. Finally, we'll tie all the numbers back to the physical building itself and wrap it all up with a checklist you can use on literally any deal that comes across your desk. Let's get right into it with term number 1. This is the absolute bedrock of any deal, net operating income, or as you'll always hear it, NOI. You can think of this as the income engine that powers everything else we're about to talk about. So what exactly is it? Put simply, NOI is the pure, clean annual profit a property kicks off from its day-to-day business. It's the bottom line before you start subtracting your mortgage payments or any big chunky renovation costs. Let's make it super simple. Imagine your building brings in $200,000 a year in rent. And let's say your operating expenses, we're talking taxes, insurance, maintenance, that kind of stuff, add up to $100,000. Well, your NOI is a clean $100,000. See that? The mortgage payment is not in there. That's the key. And here's why this matters so much. NOI is what drives everything. It directly controls a property's value and how much cash it actually puts in your pocket. If you can master this one number, you can master the deal. Because every tiny little improvement you make, bumping up rents a little, cutting expenses a bit, gets magnified into a massive change in the property's overall value. Okay, so we've got our income engine, that $100,000 NOI. But, income is only half the equation. How do we turn that profit into an actual price tag? That's where our second term, the capitalization rate, or cap rate, comes into play. Think of the cap rate as a market barometer. It's the rate of return you'd expect to get on a property if you walked in and bought it with a suitcase full of cash, no loan involved. It's the number that connects a property's income to what people are willing to pay for it in that specific market at that specific time. And the math here, it's simple, but it is so powerful. You just take that $100,000 NOI we figured out, and you divide it by the going market cap rate. Let's say it's 6%. Boom, that gives you a valuation right around $1.67 million. See that? That's the direct line between profit and price. Now here's the relationship you've got to burn into your brain. It's inverse. A low cap rate means the market sees lower risk, right? Like a brand new building in a prime location. That means buyers are willing to pay a higher price for that steady income. On the flip side, a high cap rate signals higher risk, so the market demands a lower price as compensation. It's a fantastic shorthand for market sentiment. All right, we know what the property's worth, but let's be honest. As an investor, the big question is, how fast do I get my money back? And that brings us to term number 3, which shifts the focus from the property's performance to your personal return. This is the cash-on-cash return. And this is huge. Look, a 5% cash-on-cash return means it's going to take you about 20 years to get your initial investment back. That's a long time. But what if you can get that up to 25%? Now you're getting paid back in just 4 years. And if you can find a deal with a 50% return, you get all of your capital back in 2 years. It's all about the speed of your money. So the numbers look great for you. The returns are awesome, your cash is coming back fast, but hold on. There's another really important person at the table we have to convince. Will a bank actually agree to finance this thing? To answer that question, you have to look at the deal through the lender's eyes. And their number 1 safety check, our 4th term, is the debt service coverage ratio, or DSCR. This is pretty much their go or no-go test. So DSCR is just a simple ratio. It measures how many times over the property's net operating income can cover the total mortgage payments for the year. The bank is just asking one simple question. Is there enough profit here to comfortably pay us back every single year? Let's look at the math. We've got our $100,000 NOI, and let's say the annual mortgage payment is $80,000. That gives us a DSCR of 1.25x. That means the income covers the debt 1.25 times. Now, most lenders are looking for a minimum of 1.20x to 1.25x, so you're right there. Honestly, the higher this number is, the easier that conversation with the loan officer is going to be.
Okay, so the core math is solid. On the spreadsheet, this deal looks fantastic. But now we have to step out of the spreadsheet and look at the real-world factors that actually make those numbers happen. This brings us to terms 5 and 6, the building's quality and the leases that actually bring in the cash.
Our fifth term is building classification. Properties are generally graded A, B, or C. Class A is your top of the line, brand new, best location. Class C, it's older, probably needs some love. For a lot of savvy investors, the real magic is finding a Class B property that's in a Class A location. You can go in, renovate it, push the rents up, and create some serious value.
Term number 6 is lease type. Now, if NOI is the heart of the deal, then the leases, they're the arteries pumping the cash flow. In a full service or gross lease, you, the landlord, are paying for most of the expenses. But in a triple net lease, the tenant pays for almost everything. The kind of lease you have directly impacts your real take-home profit, so you have to know what you're getting into.
Phew, we have covered a ton of ground. So now, let's pull it all together into one final actionable takeaway. This is your checklist you can use to analyze any deal that comes your way.
Here's your simple underwriting flow. 1, start with a solid, conservative NOI. 2, check it against the market cap rate to get your value. 3, make sure the debt fits with a strong DSCR. 4, do your own equity math to hit your cash-on-cash goals. 5, use comps as your guardrails to make sure you're not way off base. 6, audit every single lease. And finally, number 7, never ever forget the people advantage. And that brings us to our 7th and final term. Let's call it the bonus term. It's the one that multiplies the effectiveness of everything else we've talked about, relationships. You can have all the math skills in the world, but it won't help if you can't even get in on the deal. It's those strong relationships with brokers, with lenders, and with sellers that get you that first phone call on the really great opportunities.
So you want to make these terms feel like second nature. Head over to realestaterankyou.com. They've got the tools and resources to help you turn all of this from just knowledge into your daily deal language.